say make money, money, make money, money, money. Make money,
Welcome in, everybody. Great to see everybody again. It's been a little while. But we're all back here. This is a podcast where we talk about really interesting stocks. We present a bear case, we present a bull case, and then on today's episode, I will moderate. We also talk about some current issues and tend to take a couple shots, mostly at Gordon. But everything else is kind of above board. So great to have everybody with us, and just wanted to give you guys a little info on where you can find us. You can find us on Spotify, Apple, YouTube, and if you want to check out our slides, YouTube is the place to be. You can also email us. We recently came up with an email handle at StockJocksTips@gmail.com. That's StockJocksTips@gmail.com. Really rolls off the tongue. We might need to change that in the future. And lastly, and certainly not least, nothing we say here is real financial advice. Please contact your financial advisor before making any personal trading decisions. And with that, welcome to the podcast. We have George, Gordon, and your host today, Bruce. How's it going, guys?
Woo. Living the dream, my friend. Living the dream.
Nice. And I know you guys can't see us, but George did brush and comb his hair for a podcast where nothing is visual except the presentation to us as two fellow hosts. So,
well, you guys get to stare at me, so I mean, I got to make it delightful. Hey, Gordo, I don't think we can hear you. You're talking into the mic, but nothing's coming out.
Oh, it's muted. That's why. When I was giving cunnilingus to my mic, I think I hit the button by accident. Which I never hit the button with my wife. You know, I just leave that little beaner alone.
She doesn't have a mute button down there.
My God, I wish. Shit. I'm so glad she's not listening to this pod.
At the bottom today, guys. We're going to work our way up.
You've always been the bottom. That's what I've heard. In Miami, get tested, dude.
All right. Well, with that, anything interesting to bring up from your personal lives other than your wife's G-spot?
The man in the boat. The man in the
she
boat.
has one?
I don't know. I ask her. I don't really. Why should I care?
This was news to me.
Kamala. It's a good segue. Speaking of, people with clitori. So last time we were here, it seemed like Trump was cruising to victory, and Joe Biden was wandering the street in his bathrobe and giving out sticky candy canes, and we thought that he was going to lose, and then sure enough, he passes the mantle, and suddenly the prediction markets are predicting 60% Kamala. There's been a decent little correction in the last week or so. I'm not sure it has anything to do with the election. There's been a pretty big shift, and I think that kind of changes everybody's calculus eventually on the election.
We need someone to do the news flash sound.
George has been in a long time.
George,
I just do the old-fashioned one. It's not gonna. It's got no party beat to it to send us out, but
I feel like
missionary style. Yes. That's all, folks.
Yeah. What is like your guys' kind of take on kind of the volatility in the market recently? Is it here to stay? Is it based on the election? Is it based on the carry trade? Is it based on kind of Asian volatility? Where are you guys heads at with regards to that? Should we expect it to persist, or think we'll get to more stability in the near term?
I just attempted to knock over my mic there. I got so excited about the topic.
Hey, when you're holding it, make eye contact so I can. I really like it.
Yeah, I mean, my opinion on the whole stock market volatility is I think it was overdone. I think there was a bit of a fit from the market. People looked at the jobs number, which came in disappointing. We're still adding jobs in the economy. It just wasn't the number that people were looking to hit. The unemployment rate ticked up a point or two. Some people have been making a big deal about the Sahm roll, which is a fairly new indicator that was created in 2019 by a researcher at the Fed, and so it's back testing. It's predicted 100% of recessions, and so that was triggered based on the changes. It almost kind of measures the rate of change in some ways of unemployment. So with this last unemployment report, it technically said, hey, recession is coming, watch out. At the same time, I think you mentioned, Bruce, the carry trade. So the carry trade, for those who are not familiar, is you borrow in a low yielding currency, which historically has been the yen, has been the lowest yielding. And so that's been the popular one to go grab. You borrow the yen for basically free, and then you go invest in high yielding currencies, which today has been the US dollar. So if you kind of look at the two extremes of at least somewhat stable currencies that you want to go, make that kind of trade with, those are the two popular ones. So what happened is the Bank of Japan raised their interest rates. Meanwhile, people are looking at the US data and saying, okay, the Fed's got their path to cut now. And, it seems like we're setting up maybe for a September rate cut. And so the long-term rates are coming down, anticipating that. And so this carry trade just got kicked on both sides of that trade. Japan raising the rates, US effective rates going down, and people started unwinding. So you saw Japan, yen dive. You saw their stock market tank 12% in one day, and that carried over to our market. End of the day, I think it's the market rebalancing. I don't think we're heading for a recession. I think even if you listen to the individual that created the Sahm rule, she's not predicting a recession here. Her comment was, you still have a lot of unusual things happening due to the pandemic that are still unwinding the economy. A lot of employees sitting on the sidelines that you didn't have before. And so it's not so much that people are getting laid off. It's more that employees are coming back to the workforce, looking for work, and increasing really the supply of workers as opposed to people getting laid off. And so it's a very different type of scenario that's not like the past where the Sahm rule has kind of proven to be tested. So we're still kind of reeling from like those COVID economic numbers. But
I mean, it's 2024, right? Like we kind of had a reopening in like 2021. So I kind of don't buy that somebody was like, you know what, I'm not going to go. I'll tell you what, I'm not employed, and I can understand why somebody would leave this market and come back later because it's bad out there. I think it's worse than advertised. I think there's a lot of people with 3 jobs who are underemployed. That this employment rate is really just way worse than it looks. And just getting the feel from other people who are unemployed, like a year, you talk to recruiters and they're saying like, yeah, I don't have a lot of positions to fill. So I'm talking to people, I'm right there in the trenches, and I don't buy it. I feel like at the end of the day, it feels pretty soft. If you look at the big cloud players, not super impressive growth by, Azure, like dipping in the high 20s, right? Like public cloud is supposed to be sort of crushing it. You're not really seeing any kind of reacceleration. I mean, the company that we're talking about right now, Onsemi, they're talking about an L-shaped recovery, and we're not there. They're pretty deep in a correction. So I don't know, man. It feels like to me, I just think you got to take a negative view of a lot of this. I feel like the shoe hasn't really dropped. Like we're finally starting to see the softening. We never tripped into a recession. I feel like this is finally the yield curve's inverting. Like what more do you need? Like
the yield curve has been inverted for 2 years. Hasn't kicked us into a recession.
Yeah, interest rates are going to start coming down. Right? There's like a 60% chance, I think, being priced in of an emergency rate cut. So like that's like people are coming to Jesus that there's going to be some pain here. They feel like we've been in a recession. It's felt like a recession for 2 years.
Maybe a tech recession, right? I mean,
it has, but like the market is still like close to an all-time high. So like it's one of those things I think where what I've read is that a lot of people think, okay, the Fed maybe is a little late here in the rate cut. I personally don't buy it. I actually think the Fed, like we talked about in an earlier episode, should have raised when they've kind of held for the last couple months and tried to really crush inflation. I know it's a hot take, but I just think like this is sort of just part of the normal course volatility in the market. Like I think the Fed, like you can just see the market has bounced back even from kind of the initial drawdown. And I think that speaks to the larger, like kind of Fed consistency and the ability of the market to weather these storms. And like even in an election kind of environment, I think the market is still like poised to continue to grow. And I think there's some slowdowns across different sectors, but I think some sectors are actually picking up in terms of earnings growth, kind of in the like consumer and the discretionary space. So I don't read too much into it, honestly. Like I think it was a great buying opportunity, similar to some other things we've seen in the market. And I think the folks that were, brave enough to do that probably are reaping a lot of the benefit today. And I think the outlook still looks pretty strong.
I mean, it comes down to, I think that really, you made a good point. Like maybe there's a recession in tech where it was Georgie who did it, but I think that's fair. And there's like this sort of AI thing happening to some degree. I'm
not non-AI tech. How about that?
Yeah, I think I think it's more of a corporate excuse, right? I think what really happened is they just overhired in 21 for software growth that never happened, and now we're shooting people and blaming AI. But I'm not seeing a lot of people being replaced by AI. So I don't know anybody that was just, oh yeah, the AI bot got my job. No, you're just the third guy on the team, and they were like, yeah, we got too fat because we thought we were going to grow 30% for the next, every year for the next 5 years, and like that recovery hasn't happened, right? Like, there's a lot of renegotiating of software licenses after 21, and there's not been that kind of like, I would have thought that we'd start to see the green shoots. We're in August. Instead, we're seeing the opposite. We're seeing Azure slow. AWS wasn't amazing either, if I recall. So I think it's interesting. Like Supermicro, like their revenue guide was fucking amazing. Pardon my French. And so that kind of tells you that the underlying like AI infrastructure is pretty strong. Like they had some margin issues, but in fact, maybe the revenue would be even stronger than advertised, but they weren't implying like 12% gross margins, so like, which is fucking terrible.
Commodity.
Yeah, so I've been doing a lot of talking on this, and it feels like, some people that are pretty smart on this are telling me that this is probably Elon. And it's a lot of racks going in up front, and they can't really say that. They can't throw Tesla under the bus, but knowing that company, they're very customer friendly, and they're not going to tell Elon no. And everyone knows that Elon's a customer, even though it's not kind of, I think, formally announced in the filings. But obviously X.AI, that huge cluster, has got a lot of liquid cooled Supermicro boxes in it. But holy shit, man, what a horrific margin. Like I don't know. It's probably a near-term bottom in the stock. Also the comments about the B100, B2100 being delayed at NVIDIA, they kind of didn't really confess about that or give any insight about that. And they can't, right? NVIDIA's got them locked up on NDAs, but they're basically saying, hey, that business is really Q1 anyway of next year for them.
Jensen is not going to take any prisoners.
Yeah. Meaning what?
Got a very specialized skill set. They shouldn't have let that cat out of the bag.
Well, I think it sounds like the 72 GPU, big, mamma jammas, those are going out just fine. It's just the discrete 100 and 200 systems, I guess, that there's an issue with.
Yeah, but that's their newest chips. NVIDIA still hasn't commented on any sort of production delays. So the information reported that first, I think, and then SMCI kind of like talked about it as well, subtly, but sort of not that subtly. But I think, like, what do you think? Like, how do you think about like that revenue guide was huge? I know the gross margin was potentially an issue, but like that's just a massive guide. It's like they're clearly seeing top line growth, like demand for their.
There's no doubt. The revenue guide.
It does make me think NVIDIA's down from their highs of 140 to just above 100, so down 40% or more or less, if I know how to do my math.
For calendar 24, the people have, which there's 2 quarters left only. They have 21 million, then they have 29 million for calendar 25.
29 billion.
That's right. Thank you. $29 million. No, 29 billion. So that's basically almost 50% growth in 25. And then it has
for a hardware server business
going to 35.
I've never seen that growth since maybe like the early 80s or something.
It is fucking wild. And by the way, right, it's way bigger. It's bigger than the NVIDIA estimates are by far, right? So NVIDIA is going from 58 to 115 in 24. So basically doubling, and then going from 115 to 162. So it's definitely not growing a full 50% there. It's growing like maybe 30%. I do some rough math, but going from 115 to 162. Somebody pull out a calculator. Somebody pointed out to me NVIDIA. The thing is, Dell is just out there. They're like, we will not lose on price. I've heard that they are pricing servers $25,000 below every time against Supermicro. One thesis that's out there among the hedge fund mafia is that they're in there. That's part of the reason why they're printing 11% gross margin is that Michael Dell's in there with his pants down, smiling. Got the gimbal and everything. Austin, he's not that far in Austin, right? Hops in the pickup truck and dry down at the little ketamine party at the trailer on the Tesla site. And I tell you, people like to work with Dell, right? Like Dell has their, suspenders and white shoes when they show up. Supermicro is like, they're the super eager sloppy toppy, but you were not marrying that chick. That's a marriage of convenience in the pickup truck. I'm sure Jensen would be happy to have some other vendors at Supermicro. So I don't know what truth is here. Part of me is like, I don't trust, Supermicro guys to have a lot of trust with a company that with their history and this 11% gross margin, give them the benefit of the doubt, kind of don't want to. Kind of want to feel like it proves it's a commodity business. You're so differentiated, you can't get 15 points of gross margin. Give me a break.
I think the one thing is, though, to think about, like, the one thing to maybe note, both about NVIDIA and Supermicro and maybe Dell, but, like, these, I think even in this market, a lot of these companies are still sandbagging their numbers. Like, I think there's risk or reward potentially to the upside in a lot of these numbers. Like, they could be 30 plus next year. I mean, like, there's clearly like enough demand to support it. Like, basically Amazon, Google, and Facebook all came out and said CapEx is virtually unconstrained in these markets. Like, they are willing to put every last dollar of CapEx into these chip and GPU
and then the
companies.
B100 is at one time, right? And then you have enough power. Like, there were brownouts in Texas.
But I think power will be a constraint. I think data will be a constraint, but I think that those will be longer term constraints. In the near term, I think they'll still have resources to put to work. They'll use natural gas eventually to power a lot of this stuff, potentially use a little bit of nuclear. But like, I think, like, honestly, like they're going to continue to build as big as they can. They can't afford not
maximum market cap of NVIDIA. Like, what is the absolute, if they execute and AI is a fucking takes over every industry?
Yeah.
What is the market cap of NVIDIA in that scenario?
Oh, 10 trillion, easy.
But we're at 3 now, so it's a triple. So you're playing for a triple.
Yeah. Definitely.
Yeah. And then the question is, how much of that is priced in? Because I can certainly envision, like, God, it's insane, right? They're doing $100 billion rate right now. It's really not hard to imagine them doing a $500 billion rate.
There's no, I mean,
really not.
There's gonna be, in the near future, they're gonna be a $200 billion run rate company. That's a foregone.
And we haven't I think applications. So yeah. Is there enough data?
I think you keep hearing the infrastructure spend is happening, right? You hear the big boys planning to spend more next year, whether it's Facebook, Microsoft. They're all saying the right things, right? So like the infrastructure spend is still there. I think where people are getting hesitant is you're still not seeing it on the application side, right? The applications are not coming through with revenue. And so that's the other side that everybody's looking for is, okay, great, the infrastructure spending exists. It's going to continue. People are building these out, but so what? Does it equate to anything? Or is it like the fiber boom, right? Before, where everybody laid a bunch of fiber anticipating all these great things were going to happen. And I think that's a market question that some people have, right, as well. And that's why you're seeing some of this AI sell-off.
Did you see that Clarity.ai raised $70 million Series B? They do like some kind of document AI. Weren't we talking about some document AI company? There's a lot of like people trying to.
There's a lot of them. But very few are doing real revenue.
Tell you, man, dealing with the expenses for my recruiting trip, I'm now on month 2 months. Like, there's a lot of stupid people doing stupid things. And this is it comes one of the Mag 7 I'm talking about. We won't say who it is, but it's shocking. Like, they still have idiots like who are like, oh yeah, like, we tried to submit it. Are you sure you didn't get the fucking $2,000 for the expense report? I'm like, yeah, I'm sure, dipshit. But like, these are supposed to be like really big advanced tech companies. So there's a lot of processes that can be improved. That it's shocking how much stupid.
On the flip side of that, one like kind of slight digression is I heard this guy just recently got arrested for sending $100 million in fake invoices to Google and Facebook and getting paid on them.
Oh God, I really
got paid $100 million on fake invoices.
That's awesome. Is there like
he eventually got caught.
He eventually got caught, but like, I mean,
I would have thought the $50 million
interest on $100 million, even for 2 years, is like $10 million.
This is where I'll never be rich. I would never have the guts to go all the way to the 100. Like, I would be going at like 5 and be like, all right, I think I got to get away with this.
I think you go to 5 and you'd be like, how deep can I take this?
Yeah, I'd be
like,
dead.
How far can I push this envelope?
I'd be into our pile of hookers and blow anyway. Once I got the first mill, I'd be fucked. You know?
That's probably the problem.
Yeah. Oh, I have to buy lots of Narcan.
And with that, let us segue to the main event. Today, we are talking about
one last comment. I'm always dragging it
semiconductor.
out, I know.
Before we jump there,
Victory lap.
George is going to make one final
our
comment.
last name. I know you're trying to cut me off here, Brucey, but Shop. Did you see the quarter by Shop?
We didn't. And so with that, let's go to
It's our third most downloaded episode.
Anyways, they killed it.
Downloaded the Shopify episode.
Delivered on the quarter.
Like I said before, stop talking about the
small end of the market. Oh, this is going to sound horrible here. All right. Anyways, shop really fast. They killed it. They beat expectations, guide above, the 20s, which I think is kind of the key point for them that everybody watches, and especially like servicing small, mom and pop shops is a big part of their customer base. I think people were worried that's where, economic slowdown was going to be felt, and they delivered a masterful quarter. So stock was up 18%.
Time to sell?
What's that? Time to sell? Time to hang in. Double down.
Can't lose money taking profits.
That is true.
Even bouncing. Like, when was that pod? I feel like you're still down on it, right?
It was a month. It was a month ago. I do track. I think it's slightly up. The whole market was peeling down. They were taking it pretty hard. I think everybody was nervous about anything touching.
Wait, you're doing a victory lap on a stock that's basically flat?
In a market that's down, yes.
Well, yeah. If you're there was some alpha there I guess. But yeah, it's kind of still like bouncing. I think it was kind of in the toilet when people were worried about the consumer. All right.
Well, with that, let's switch over to the main event. Today we're talking about on semiconductor, and the bull case is Gordon. And the bear case is George. So with that, let's hand the mic over to Gordon to kick things off.
Excuse me while I whip this out. Let's see how to share this bitch.
Shouldn't take long.
I know.
I can't see it.
Here we go. All right. Take the blue pill. Here we go. Me is giving me a semi. That's the title. And so when I say a semi, I'm referring to a semi-erection, a corpulent phallus, if you will.
How many female listeners do you think we have?
You're pretty off.
Zero now. All right, just keep going.
We have a lot of Algerian women that are watching. So they're very rough, though. They have rough edges. A lot of spittoons at the Onsemi.
I wouldn't get in the ring with them. All right.
Yeah, I would not. Yeah, definitely sneak out quietly. So, I have the crying game in my head. So anyway, I'm going to lay out the conclusions before, so you see the road that's coming here. So basically, the bull case here is, Onsemi, they're differentiated. They have a moat around their technology. They're a play on EV adoption as well as data center growth. Power, we just talked about, big issue in data centers. These guys help with that. Valuation does not reflect the growth opportunities. Companies at a bottom of inventory correction that is already long in the tooth relative to history. So, I don't know. I feel sorry for George, but that's true whether we're talking about a bull case or a bear case. As is our custom, just, talk about our company. This has got a picture of He-Man for a non-watching audience. Get them to YouTube to see our slides, but I was a big He-Man. He was all about power, and so was Onsemi. Like, these guys do a lot of semiconductors, move power around within a system. They also, really importantly, do so really efficiently because power is becoming an ever important thing in our world, whether it's the range on an electric car or it's in a data center where you've got so much data and you're adding so much that you're running out of power. So
can we sidebar on He-Man for a second? Like, how many mushrooms was the creator of He-Man on? Doesn't he ride like a cat that's kind of like a puma or a lion or something? That's like
and there's Orko. Orko's a little bitch. He-Man had a gimp, definitely in the style, the steroid He-Man 80s kind of style, right? He was the Conan the Barbarian kind of thing, right?
Does he ever wear a shirt? Does He-Man ever put on a shirt, or is he always shirtless?
He does. He's Prince Adam, but it's like really tight. Yeah, a lot of good lessons from that show. Including hold your sword, including hold the sharp edge of your sword with your bare hand. That looks like
that would be well advised. But anyways, let's keep going.
So let's talk about the biz. June of 24 quarter, they cut it a couple different ways. So they do like, and so by the way, like they're going through a pretty massive correction in automotive industrial. There's a lot of EV exposure, but on the left, it's like they have these business segments they call automotive, industrial, and other. And then you've also got, they basically do it a different way, like intelligent sensing, which is like sensors for cars for assisted driving or self-driving. Then you've got the analog and mixed signal group. And one thing to kind of understand here in general, like, we divide the world of semis into analog and digital, and analog is kind of like black magic because you're not just dealing with ones and zeros, you're dealing with waveforms, and like radio frequency is kind of a classic area. TI does a lot of analog semis, but like it's considered a good neighborhood because there's a little bit of black magic, like when you're dealing with waves and interference, and it's just a lot of nerdy stuff in there. But at the end of the day, like these guys have differentiated products, and I think that's kind of somewhat reflected in their margins. Like here's like the applications. Like, so again, going back to the segments, in 23, automotive was half, huge amount of EV in it, I think, and assisted driving, and then industrial is 28. But again, charging infrastructure is part of industrial, so you can't even really just bucket the EV in just that one point. But they're pretty broad, and it's kind of reflected like an $8 billion revenue company with $30 billion in cap. Like it's a broadly diversified semis company that focuses mostly on power and sensing. But there's a big chunk of automotive and industrial exposure, and that is really hurting them right now as the sort of economy, as we talk about, slows down. But more importantly, EV in general is just kind of in a nuclear winter right now. There's a content story here again, but like it shows you that you can kind of take some. They apply to a lot of end markets. Like they get like up to $4,000 in content per charger. You can sort of multiply some of these things out. A lot of inverters for, I guess, windmills. There you go. Trump can be excited about that. And they talked about, I wasn't that impressed by 10 grand per factory. Like that doesn't seem very great, but like $150 per server for 5G in the cloud. And there's a lot of like content story, and they think they can grow this. I put the slide in here because they think they can grow 11%. This, by the way, came from a very poorly timed analyst day. We'll get to that. But there's any kind of electrification, any kind of ADAS or assisted driver adoption, upgrading energy infrastructure. Like, these guys are still playing on like just there's not a lot of energy out there. It's scarce, and these guys have power solutions, and kind of a handful of companies out there like Monolithic Power and these guys that do these kind of things. So, I'm going to argue that Onsemi, up until recently, kind of had their mojo back. So you got a picture of our friend Austin Powers. From like go back to his teeth is as good as mine. So a lot of chewing tobacco in mine. That was Indiana wrestling days. Old Onsemi. Let's look at 2014 to 2019. So like the green line is there, and what this shows, like in the SOX indexes on here, I put the NASDAQ on there. They basically had some periods of outperformance in 2017 and then came back. But like at the end of the day, like, they ended up over the course of 5 years giving exactly return on the SOX. It's like there were periods of outperformance, but like, it's sort of like, not amazing. But hey, up until recently, from like basically the end of the pandemic all the way through kind of 24, and it kind of mirrors somewhat like the EV adoption and the rise of Tesla to some extent, but they had some periods of massive outperformance. So I'm going to kind of argue this is a little different company.
Except now they're getting back in line with the SOX again. So maybe it's just a longer term trend.
And just as background, the SOX is the semiconductor index.
Yeah, it's just the tip is touching there. But actually, look, there's still a fair amount of performance. Over 5 years, right? These guys have outperformed basically 100% versus the SOX, and over 3 years, they kind of 57 versus 39. Starting to run into some trouble over the 1 year. And I would argue like not a lot of the SOX, because they're focused on power and EV, so they underperformed the SOX by 60% for the last year. Last 6 months by about 5. They've had a rough go of it. They are down 30% in absolute terms in the last year. And so it kind of, you'll see that basically.
But I guess like when you think about it, do you think that the SOX is the right comparison right now, just given like semis in general, it's feast or famine, right? Like the best semi companies have traded up probably faster and higher than they ever have in history. which makes it
Relative
look
benchmark,
like.
right? It was, like if you're managing a fund that's focused on, say, semis and hardware, right? Like, I don't know, some of those guys are benchmark for the stocks, I think.
If you're I think if you're managing a fund, that's true. But if you're managing like your PA, like I would think you would benchmark it against the Nasdaq, right? For example, like that's a
It's not that different. I mean, in some ways, like the stock's just a little more volatile, but it kind of mirrors it, right? Like it's still massively underperforming on a 1 year and 6 month basis versus the Nasdaq.
Yeah,
And
it'd be interesting if you pulled NVIDIA out. What does that look like, right?
Yeah, that's actually.
because there's a couple of companies though, like AMD is probably in the stocks, like
AMD and
SMCI is probably
Broadcom.
like,
Nasdaq
there's a lot,
too.
like, yeah, Avoga or Broadcom, yeah, it's like
They're all on the Nasdaq. It'd be interesting to pull it apart. But at the end of the day, I think what it really shows, there's some company specific stuff happening here, and like they've had a massive correction. I think it just reflects mostly their exposure to the EV market, and so to a certain extent, like if you want to buy this, there's a timing component around. How long is this downturn going to be? They're still talking about an L-shaped recovery on their call. Like, that's not great. Like, it's just going to be shitty, and one day we're going to wake up and it's going to pop. And that's kind of how semis work, right? Like, it's like not good till it is. They got a bunch of secular themes. All these end markets are growing, like 8 to 25%. Fine. I just showed you like all the different places. Like, it's just like very diverse. Like all the different little modules and chips that go into cars. Like this is the picture of the BMW and all the places that I'm showing here on my slides here. That again, this is the first time I'm mentioning silicon carbide. That they have a particular technology that's extremely important to improve the range on electric cars. And there's kind of a transition occurring, and they've committed to grow like 3x the growth in that market, and that's what's growing 25%. Like,
here's like our listening only audience. Like if you look at that car, I mean, it's basically from like front bumper, engine, inside the car, rear suspension to back. Like they're basically all over the cars.
Like, they've got some announcement with Volkswagen, BMW. Like, you're designing for years at those places, and like those are kind of locked in sockets. So like in some ways, the semis, the analog semis business and their business, like they're number 2 in silicon carbide and silicon power. They've got about 9% share. They are number 1 in audio industrial semis, 68% in ADAS. These are a couple year old stats. So like they've got some like market leading technologies. Like that's the point. Is like these are not like commodities like Supermicro. And so like again, semis, you got it. This is semis and hardware, man. Like at the end of the day, these are components, and there's going to be stocking and destocking, and you're going to have some volatility, especially with like a new technology like EV and when you kind of got like boom and bust and head fakes, and all kinds of issues. And so on this next slide, I'm just showing like their sales. Like basically, they've had some really impressive sales. Like they were growing like 14, 11, 12, 42, like 6, and then all of a sudden -6 and -5, and then back to 28 and 24 positive, then down to -1 and in 24, and they're actually expected to be -13 and 25. Like that's not beautiful. There's been some like exits of businesses too. So like they've been pruning the portfolio and trying to go fab light in places where they can or need to. And so, it's this business in transition. But the point is like off this new base, people are forecasting like basically 8 to 16% growth, like 12% in 26, 16 in 27. I think this is interesting. The EPS has been even better. They've had a real good gross margin improvement story and a leverage story. But if you look at like these sort of actuals from 2019 and 2023, EPS grew 36%. If you look at like, what's expected to happen, like 24 to 26, 22%. Like look what's expected 24 to 27, 23%. So I bring this up because it's super volatile. And I think that you can argue for like a low 20s sort of sustainable growth rate in earnings, and the P is not going to reflect that. I mean, just to give you a quick kind of like, where they're feeling.
Isn't some of that performance driven? Didn't they make like a big strategic overhaul of the company at some point pre-pandemic there, where they kind of got out of some markets or de-emphasizing certain markets, and they're doubling down on their core markets?
There's
driving
definitely
a lot of yeah.
There's been some pairing. You can see this like on a quarterly basis, like where things are like kind of like other is like I think where some of their divestitures were occurring, right? They went from like 700 million. Yeah. So they're down 42%, right? Like, so like there's been a real pruning of like things they aren't number 1 or number 2 in, and I think that's behind us. They've done some minor acquisitions, I think huge. But like, this chart, I mean, you can see where the actuals end here in June of 24. I should have put some ease on that. But like, people are kind of forecasting for more of that other business to roll off, and like pretty deep, like in September. And, they have still an automotive industrial down 20 to 25%. Like that's, whew. It all started basically in Q3. You can see they guided down Q3. I'll show you the surprise analysis, but like when that minus 28%, really it's the minus 10 industrial. Like that's in the December quarter. Like that's when you really start to see things, and then minus 14, minus 23, like multiple quarters of double-digit declines in industrial. And then it began automotive in June as well, year over year. So it's just like pretty broad and deep. And they're talking about like basically they've had some destocking, like 8 to 9 weeks of inventory in the channel, similar to last quarter, but like China's been a challenge too, which has been slowing. Like they have some exposure there. So it's kind of like things are not amazing right now, which by the way is a great time to be in a stock when things look like shit. I will say they have
one question. Just one quick question. Like how tied or how correlated is the performance of the company to like the EV cycle, right? Because there's a lot of headlines around EVs kind of trending sideways in recent quarters and maybe even recent years. There's a lot of risk as you think about the future. Like how tied is this company to either even the headline cycle and also maybe like kind of the underlying fundamentals there?
I think it's so hard to say. I mean, I'll tell you, last year they did $1 billion in silicon carbide sales on $8 billion in total revenue. So it's, it's like, it's like a little over 10%, right? That's one. I don't think it's the only thing they do for EV, right? It's not all silicon carbide. But I think, there's base stations that use silicon carbide, but like, I don't know. I just feel like this is, because they're so broad and diversified. And by the way, the EV market's pretty hard to get your arms around, right? It's still very much a penetration story. And, you've got like BYD and like, all these kind of like, you got companies shutting down in the EV world. Like it's very hard. I think it'd be hard to even create a time series on both sides that makes any sense. So I think short answer is, I don't know. It's a bit of a black box. I will say that they have had some success in life. Like back in 2010, they did an analyst day, and they talked about their margin goal is 43%. They're still doing 45% gross margin right now with their revenue down double digits. So like, I mean, if you look at in Q4, they did 45% non-GAAP gross margins, down 200 basis points. But like, they did a lot of good stuff. They did some pairing, and the fact that they're down, they gave you some info on the call. They're only at 65% utilization in their fabs, and it's like, I want to say it's like 15 basis points for every certain amount of revenue. It was a pretty dramatic leverage in the business. So like that 45 is pretty impressive if you consider that the revenue is down 17%. And you can see again, I like how they did this, these down arrows. Like it was really hard to figure out that these numbers were down. You had to find that weird little icon, the down icon. Good job, you guys in IR. But so this is like one of the shittiestly poor timed analyst days. So they did this, I think, in like May or something of 23. And, they talked about like, taking this 49% gross margin to 53, like, they were shifting new products, silicon carbide's profitable, and grow at least 2x the market on silicon carbide, doing fab optimization, right? Like fab divestitures. So like, doing the right stuff. Row. So like they do this like analyst day in the front half, and then they guide, they missed their guidance by 8% reporting Q3 of 23. And they have continued to guide down every single quarter. And the guide downs are getting less. And in fact, the stock's trading up. Like Semi's right by the confession, right? And like there's some wisdom in doing that. I'm not sure, the market's pretty wild. But they have, this is still in their quarterly deck. I mean, they got some balls. I'm going to show you what this actually looks like. They're saying 10 to 12% growth for 2027 of a 23 actual 8.3. Like they actually did a flat 23 around 8 billion, and then they're declining in 24. So they've got a lot of catching up to do. Like they're just go 3 times the semi industry. And so I think they can do it. I think it just shows you the fact they haven't taken the slide out shows they haven't given up the ghost. But this is what it would look like if you were going to grow 10 to 12% like they said they would. God, do I sound like the bull still? Like this is what they would have to do, and so they are not, this is what the street has, like it has them for our non-viewing audience. Like basically the street has them recovering to 10 billion. That's 4 billion shy of what their 27 goal would have been if they grew 11% CAGR. So like people are not imputing a lot of love. And again, going back to, I'm going to skip that, but my add-in for Excel broke, so I have to use the comp table from fucking FactSet, so it sucks. It uses fiscal years, which could be a little bit differently aligned. But at the end of the day, I think it's roughly right. The comps are roughly right, like Monolithic Power and Microchip and Marvell and Skyworks and Onsemis. Yay! But you look at that group, let's just take PE. A lot of analysts are using PE at this pretty mature company with 8 billion sales. So you got like 25 times as the average. These guys are trading at 15 on the out year. You know, in the next fiscal year, it's like, which is closer to the next 12 months, like that's like 18 times versus this average of 38. You know, there's some weird numbers in there, like at Intel at 55. Like, you need to take the median, that's 38. Like, it's kind of like everybody's pricing in, I think, a recovery, and these guys are not. I love that. Like, they stand out as a very unpriced. You know, again, I have this next slide to show you that they've got, you know, about 800 million in 2023. So I said $1 billion, I was off. So that growing 4x in 23. So they were very coy and wouldn't talk about how much that was, but like silicon carbide, that's a big reason why people are involved in this stock. So I'm going to go ahead and let, you know, at the end of the day for me, like this is again differentiated. It's a play on EV adoption and data center growth. Like there's a lot of solutions and modules that are going into data centers. I showed a content slide that sort of touched on that. Valuation at 18 times, like when I think they can grow 23, like, you know, and there's just a massive inventory correction happening. Like, I feel like, you know, maybe I'll be timing it wrong if I buy it now. Maybe I have another couple quarters of suffering. But, you know, I feel like you can't get cute about this shit and wait. It's an L-shaped recovery, right? You're going to wake up one day and this thing's going to be up 30%. It's going to be right back to its all-time highs when people realize that $14 billion number is real eventually. And, you know, I wouldn't be surprised if before 2027, the estimates go back to 14. So bottom of inventory correction, it's already kind of long in the tooth. You've had basically a year of this shit. I don't know how long it's going to last, but given, you know, 18 times, given where that's like below the S&P, I think. Like I would definitely, you know, I feel like this is a good neighborhood to be in general. And so, you know, for me, it's like, it's pretty broad and diversified. You're kind of just, you know, buying the confession. You know, you've already, and you know, thankfully you've seen, a whole year of that now. So, you know, I feel like a lot of negativity is baked in. So with that, be happy to hand it off to my less bullish friend. My what is your name? Bear Boy.
Just call me He-Man.
That's right.
These handsome guys up here on my slide. So it's our main shot here. All right, so I entitle mine "Get Off the Semi" instead of "On the Semi," and that's no reference to penis jokes there either.
Get off on.
I don't even really get it. Get off the semi.
Get off. It's on semi. You're getting
joke?
off of it, right? So,
Oh, I see. Off versus on. Very got it.
Yeah, I know. There's not a lot of clever things to do with this name. So, anyways,
Change the format. There's already a 1 point deduction here on the slide.
Format. You know, I hate this format with these lines going through. It's horrible. I don't know who chose this, Bruce, but it sucks.
That was Bruce. This is a 1 point deduction. Keep going.
What I made it like not white in the background. It's like a slight gray to give it a little interest. Anyways, so I'm gonna fly through here. Some of the slides, even you will see look similar to Gordo's. So the way I think about analyzing a semi stock, anytime I look at one, is I think the easiest way is to look at what are their end markets that they're serving. Are those growing end markets? Are they becoming more digital? The more that they're requiring digital content or to be digitized, let's just say, they will require more semi components. The second is, are they gaining or losing share?
One quick question. What is Diddyization?
I was noticing that here as I was speaking. I was hoping you guys would miss that. I'm going to call that I don't know. This is what happens when you do your slides over a couple beers at 11 o'clock at night.
Another point.
It's got to be good for semi stocks.
Is that like P Diddyization?
I thought that was an industry term. I was gonna roll with it, but
you're gonna roll. It is. It's really good for semis. Just trust me. So if you digitization with a Z, then you're in good shape. No G's required. And then the second is, so is that industry growing? And then are they gaining share versus their competitors? Do they have a differentiation? And I think for Onsemi, like I think they are actually doing pretty well on number 2. I think they are holding their own, even gaining share in a lot of their core markets. And so a lot of what I focus on is really looking at these end markets that they participate in. And so similar to Gordo, I looked at kind of what are the different industries they're in, and so what are the ones that they're really tied to. So I didn't have time to go through each of these, so I picked kind of the biggest and fastest growing ones, looking at again EVs and automotive, and then energy infrastructure as well. Those are the ones that have double-digit CAGRs that they're tied to and have the biggest TAM. So that's probably about 3/4 of their TAM sits in that. And particularly they're tied to EVs. That's where their big bet is in terms of, as they've repositioned this company for growth, betting on that market. And so as you look at recent performance, and so I won't, beat a dead horse here because Gordo already touched upon this. Everything kind of across the board has been pretty much negative on their performance. Revenues down double digits, 17%. Gross margins decreasing. Operating margins decreasing. Somehow they're increasing cash flow on a trailing basis, I guess, last 12 months. So there's probably still a few good quarters snuck in there. But everything last quarter was down. And so it's all heading in the wrong direction. And this is a different shot of what Gordo also showed. But the one thing I wanted to highlight here is we look at their end market split again by automotive, industrial, and others. And so if you go back to September of 2022 and you look at the growth rates they were experiencing, these were in the 50s, and then in 23, it's still in the mid 30s. And then it starts to really fall off a cliff come end of the year, December 2023. So they go down from 33% to 13% growth. Then in the March quarter of 24, they're down to 3% growth. So they decline, 10 percentage points of growth there. Now, for a stock that I'm going to get excited about, I want to start to see a turn in terms of timing of this market. And I want to say, okay, that decel is slowing down. And so you kind of felt like you might have had that in the March quarter. And then bam, we get hit with negative 15% in the June quarter here. So in a lot of ways, it's actually re-accelerating. That downward trend is re-accelerating again. And then you go over to industrial and you say, well, maybe that's just the automotive. No, it's also industrial. Industrial is also accelerating its downturn. So in December of 23, it was down 10%. March of 24, down 14%. And then it jumps, instead of going down another 4%, it jumps 9% down to negative 23%. So it is decelerating at a faster rate. Yes, Bruce.
But the thing is, like, if you kind of wait for it to reaccelerate, you might be too late, right? And so, I guess when you think about these end markets, is this an Onsemi problem? Is this an end market problem? And like, ideally, obviously, you want to be ahead of when everybody else, sees a jump in growth or jump in margin.
Yeah. So I agree with that. I think a lot of this is really around timing and thinking about the timing. So to your point, once the turnaround is obvious, you're going to have missed a lot of the gains already, right? And so it's okay to be buying when it's a negative print still. If you feel like you're starting to see signs of stabilization. In my mind, I'm not sure we're seeing those signs of stabilization. And so that's the challenge. But I agree with you. There's an art here to saying when is the right moment to jump in and how much risk are you willing to take? If you're risky like Gordo here, you're like, hey, I'm in now and I'm just going to ride it out. It's going to be rough for a while and then maybe I'll get the upturn. If you're trying to preserve some capital and say, hey, I'll let a little bit go off the table before I jump in, like, I want to see some signs of improvement, and then I know at least we're hopefully heading in the right direction. It's another strategy. I think it's all your risk profile in terms of a stock. But right now, like, at least from these numbers, I'm not seeing any stabilization that's happening. In fact, it seems to be heading the wrong direction. So looking at EVs, like, this is what's driving a lot of the challenges. And EVs in particular have been hit hard by rising interest rates, as have most new cars. However, when you look at the two markets of EVs versus new cars, EVs are coming down in price. The demand is falling off a cliff. A lot of that's being driven by Tesla and others, Well, the average price of a new car is going up, and so these two are moving in different directions. So in some ways, it feels like the EV market was overhyped and continues to be overhyped. In fact, when you go farther out and you look at the cost of new cars, they've increased quite a bit. So there's a lot of inflation that really happened in 21, 22, and 23 there around new cars. They increased from an average of, call it, what was 2020, maybe around 38K to now 48,000 for the average price of a new car. And so the consumer is really getting squeezed here in terms of, new vehicle purchases. And on top of that,
right? You're getting close to, you're no longer, price was a big reason to not buy an EV. Now it seems like they're getting closer and that it's become, price is no longer an issue. So I would say that's going to spur adoption ultimately. Maybe not now. Maybe it's a mark of desperation now and pissing into the wind in a weak economy. But
or in general,
EVs
just
are cool.
Squeezing, people are going to hang on to their cars longer. They're getting squeezed, right? New cars are out of reach. You're going to see less and less new cars. And so the cost of auto insurance is another thing that's also been driving up. If you look at the CPI recently, that's been the number one driver. So it was up 22.6% from last year. It was the largest annual increase since 1979. So consumers getting squeezed on the auto side quite a bit in terms of buying new cars, both from pricing as well as higher rates. And what you see Americans are buying less cars. And so here's kind of the average age of the car fleet across the U.S. And I will say this is a global company. So the U.S. is only one market that they're in. They actually do quite a bit outside of the U.S. So you can't overextend this analysis. But if you look back to 2012, the average age of the U.S. car fleet was 11 years. Now today you're at 12.6, and it seems to be accelerating, especially on the car front. Light trucks, which are maybe more commercially used, are a little more flat, but cars are really skyrocketing, driving that up. And so people just aren't able to afford this market and these more expensive cars with all their digitized components.
And interest rates are up on loans too, right?
Yep.
Cars are more expensive for that reason too.
Yep. Interest rates, exactly. And just, I'm continuing to beat the dead horse here, but Tesla, for the first time since, they had to shut down their factory during COVID, saw a decline in quarter-over-quarter deliveries here. So they were down. It had an 8.5% decline from first quarter 23 to first quarter 24 on vehicles delivered.
Because woke.
All right, and then here's my long-term bear thesis that will really hurt these guys is if you believe in Waymo, so or you believe in Elon and the robotaxi story. So if you think about robotaxis, the goal of that ultimately would be that not everybody needs to have multiple cars in their garage. In fact, maybe you don't even need a car in your garage. You can turn it into usable living space because end of the day, you will go everywhere in robotaxis because they don't need a driver. They'll be cheaper. You don't have to pay insurance. You don't have to do anything. You get in the back seat and you go where you need to go. And so
the number of miles from the trip doesn't change. And more of those miles are going to be EVs if they're robotaxis.
Yeah, but an average car is utilized. So according to this, an average car, Clean Techia, says the average car is used 5% of the time, which is probably accurate. My car spends most of its time sitting in the driveway, to be honest, right? And so if you suddenly have robo-taxis that can be constantly used, right, going from job to job to job, you could replace, for every robo-taxi, you can replace almost 6 vehicles, or call it 5.5 vehicles today.
So you're saying that the car team is going to be 1/6 of what it is when the robo-taxi trend catches on. This is some of the public cloud.
There's a risk, right? We can talk about time frame and how long this takes, and is it realistic? Granted, would I get rid of 2 cars? I might get rid of 1 car, right? It's nice to have 1 car.
It'll be all Teslas. You're making the argument that it's going to be all Teslas. That is basically the best dream scenario from these guys ever. If every car gets replaced with a Tesla robotaxi, this is a screaming buy.
But the tail on this trend is 2035 to 2040 or something, just unreasonably long.
You think so? I don't know. Waymos are great in San Francisco, let me tell you.
Yeah, but I think it's still going to be a full decade. You're not seeing car companies.
I think it's legal lag. Yeah,
car company
too many
volumes
entities.
aren't trending down. Like
Not yet.
this is
No.
something that happens over a long period of time.
Yep. No, I would agree. I think there is a long tail here, but I'm just saying there is some cap to this market at some point. We're going to get more efficient in terms of the number of cars that each economy needs to use to really drive it. And I would say China, which is their largest market, is actually ahead of the U.S. in a lot of ways here. So that's watch out below if that does happen. The other thing
I'm going to argue they're in robotaxis. I'm going to disagree with you there. That basically we want robotaxis that are all EVs to be adopted. That's probably better. That trend of EV replacing cars is probably more tied to robotaxis than the people getting rid of their cars at home. In fact, I would argue they probably still have both. They'll probably still have that car and it'll be 1% utilized because people still want to be able to hop in their own car and not deal with it. And that habit's super hard to change, to your point, Brucey boy. But anyway, go ahead. Proceed.
I guess do all robotaxis have to be electric? Doesn't have to be.
I think most are, though. I think they will be, though. And Tesla is probably the leading. Aren't the Waymos? Wasn't that an EV you showed me? So the brands that I know that are most famous
they don't do
robotaxis.
Teslas. Isn't it like what is the Waymo car?
Maybe.
It's like a Chevy Cruze or something. I don't know.
I think that's an electric.
No, it's a Volvo.
What is it?
Somebody Google that. But at the end of the day,
I think it's a Volvo or a Jaguar, right?
Oh, I think you're right.
it is an EV. There's no gas. Well, there's a charger thing right there. So I'm going to argue that pretty much all the major brands, and Tesla's like the one that
It's a Jaguar
I-Pace.
Jaguar I-Pace.
Okay.
Yeah. I mean, it could be a gas powered car, but yeah, fair. I won't disagree. Like, I think probably more likely than not they'll be electric cars. There. The other end market that I just highlight when we talk about energy generation, a lot of it's focused on renewables, and so solar is the other thing that in certain markets has had a lot of challenge. And so when I went to go look at like the solar trends, and this only goes through 2022, so I'm probably missing some of the more recent here. I haven't found great trends for 2023 and 2024. But this is another interest rate sensitive market that's really turned down, and I think particularly you've seen it more in like the residential markets. And so On doesn't give you a lot of details exactly into where they service all these customers. My guess is they're more heavily tied to these types of customers that are serving that market. So like I know, for example, like Enphase services a lot of residential customers. That's one of their customers. So again, just tied to very cyclical markets. And so what that comes back to is, again, I think from a competitive standpoint, like I think they are gaining share. Like their last earnings call, they highlighted a big win at VW, right? One of the biggest automakers in the world. I forget if they're number 1 or number 2 now, but they're definitely up there. They are doing very well in the space. So it's really like, what do you believe about these end markets, and is this fairly priced for what you're getting? And so one of the reasons that I would say they have like the highest exposure up here, tied with NXPI and who's the other one? IFX, in terms of exposure to the auto industry. And the auto industry is probably as cyclical as it comes, right? In terms of ups and downs. And you look at light vehicle sales, and I had a chart that I cut here, but it is like a roller coaster that you go on. And so this is going to be a stock that continues to be cyclical. Cyclical stocks historically always trade at a discount to the larger market. The more cyclical you are, the more volatility you have, the lower multiple you get assigned, because really that's, if you modern finance theory says, hey, if your stock is volatile, you need to give folks a bigger, discount the future cash flows at a higher rate because they're less certain. And so from that standpoint, when I look at Onsemi here, I kind of look at, I think, similar names to you, Gordo, but they are trading at a forward PE of 17 times. They have forward EV to EBITDA of almost, call it 12 times. It's not out of whack with a lot of these like higher price names. However, when you do look versus NXPI, which we were talking about, or NXP Semiconductors, NXPI is their ticker, that's heavily automotive, and you look Infineon, which is also the heavily automotive, they're trading a premium to both of those ones. And yet they're expected to do worse in terms of growth. So next 12 months, estimated revenue growth down 7%. And even profitability growth is expected to be down 10% over the next 12 months on an EBITDA basis. And so that's below NXP, which is expecting positive growth on both of those fronts, and Infineon as well. And so my question is, is this a company, one, in terms of timing that we want to bet on that still has decelerating trends? And then two, seems to be overpriced versus competitors who have, growthier expectations here in the coming future. So feels like there's still room to go down on the multiple. Feels like these markets haven't turned. I think we're in for more pain here until we actually see signs of growth, both from multiple and just continued deterioration of their markets. So that's the bear case. Otherwise, like the company.
One quick question on the PE. How does it compare to their kind of long-term PE EPS growth expectations?
Yeah, I had seen a chart on that. I think UBS had put one. Was it UBS or it might have been someone else? At least it was a little outdated because I think it was from the prior quarter, but they were trading, like slightly above their long-term historical. So it was like 5% above or 10% above, somewhere in that range. So you'd say it's fairly in line, maybe a slight premium.
Got it.
I don't know. I can pull up I don't know. Let's look at what time period, like 5 years. Like their PE. Oh man, some of those companies get rid of shop. Let's see here. So it's been, I don't know if that's right. I mean, they was trading like 30 times next 12 month PE in 2021. I don't know. It could be average. There were times when it was I guess it went down to 6 times when it was that was in March 18th, 2020. Like it's never, other than that moment, it never went below 11 times. Never, it feels like there have been times it's been around 20, but it's been cycling, ignoring that sort of big pandemic surge, kind of between 10 and 20. So yeah, this is not wildly different, but it's definitely not like expensive.
Yeah. So here's what I found the chart I was looking at. So it's on a EV to EV EBITDA basis. This was as of, I think, the March quarter. So their 3-year median, they're about 5% premium to their 3-year medium at 12x times EBITDA, next 12 months EBITDA. And I think that's even come down from what I was showing before. So it's a little out of date. So they might be a little bit lower there than historicals.
They're pretty fairly valued though on growth at least.
Well, I'm saying that they're going to grow. Even the street has got in this very dark moment has them growing 20% plus. I feel like this is going to grow. You peg it's barely a peg of it's a peg less than one, right?
You believe in the long-term growth rate, yeah. Shitty. I think it's a question. I don't think it's a question of, is this a good company? I think it's a question of, is it the right time to buy it? That's honestly where, my head goes. And so it kind of goes back to that question of like decelerating trends right now, not necessarily trading at a discount to its closest peers. Like, is there a compelling reason that I pull the trigger right now?
I just feel like you're being cute because semis, you want to be buying them when you buy the cut, right? So this is a nasty auto, like down minus 25%. Like Tesla is hated right now. Like I feel like it's a good time, to rip and winkle this thing, right? Put it in the closet and go to sleep. But yeah, is it the right time exactly? Could there be another quarter where it's basically dead money? Sure, but the risk reward in this thing, I think, is pretty attractive. That isn't my real opinion, by the way. I think it's. I agree. I don't know if this is if I'm going to be happy with this 3 months from now, but pretty sure I'm going to be happy with this a year from now.
Yeah.
Yeah. And just for the record, it's at 11.7 times EV to EBITDA now next 12 months. So it's slightly below its 3-year average, which was 12.
Nice. So should we just go around the horn and vote? I'm happy to.
You got my vote. I just did it. I'm a bull. Still, for real.
So I'll give you my real opinion. I'm a bull. I don't mind buying early, to be honest with you. I do agree the risk reward is well set up. I think you could have a painful year, but I think eventually you're going to be smiling. This thing will, to the comment of an L-shaped recovery, at some point the stock will be L-shaped. And so, when those end markets turn, this thing is worth a lot more. They have a lot of earnings power behind it. And so historically people have been able to make good money buying semis in the lows and coming back. So unless you think their end markets are really impaired or they're going to lose share to somebody else, which I didn't see any evidence of, why not take it? In fact, I bought some actually when the market was pummeling, since this was a name I was refreshing myself on. So I am a shareholder here.
Yeah, especially this is the last cut. I think it might be, but I don't know. I mean, like a lot of
You
these
gotta
stock
hold
teams
your
already
nose a
occurred.
little bit and buy, and like I like to like trickle into these positions. So buy a little now, buy a little in 3-6 months, look for dips and add to it.
From my perspective, I'm on the bear side here.
We need a consensus one. This is what makes a market, right?
This is not going to be a consensus one. I think to both of your points, there's just a lot of volatility in the end markets, and like taking that type of risk, I think is tough to stomach, because even if the end markets do turn, there could be another 10, 20, 30% down here before you ever end up getting back to even neutral, let alone going up on the position. And so like it's hard to stomach, I think, cyclical companies in any context, but especially ones where you see downward trends in those markets, even if ultimately you feel like they'll come up. And then the other thing that like I'd try to consider when I'm investing, at least, is like, what is it going to take for this company to double effectively? Like, how strong are these end markets going to have to become in order for the company to double? Like, because you have to believe, even as in any cyclical market where you're buying at the bottom, that this is a long-term trend. You're going to be holding this company for a long time. You're going to be tying up your capital for a lengthy period. Like, what is it going to take for this company to go from 30 billion to 60 billion? And I think it's a huge step up, kind of across the board. Not only will they have to get a lot of operating leverage to pull up cash flow, to pull up EPS, like they obviously don't have any consistency in terms of reporting and guiding on their own expectations, as Gordon showed us. And then they're also going to have to compound that by selling into favorable markets, which doesn't seem like it will be the case, at least in the nearer term. So I'm on the sidelines here. I think it's too risky for my appetite.
What do you think? I mean, if you believe, and maybe you don't believe, and it is hard to predict this, but if you believe there's going to be interest rate cuts, that will help a lot of their end markets, whether it's EVs, solar, all those things really benefit, quite a bit from that. And it seems like, at least in the US, that's what we're staring at is, coming interest rate cuts, and the long-term rate is already coming down. So if that, that feels like it could be kind of the change here in direction that's got me excited that, hey, these end markets could get a boost from the interest rate cycle.
Honestly, from my perspective, there's better ways to play interest rate cuts than investing into a semi company. Like, I think that you might get like some uplift, but I think a lot of companies will get uplift from interest rate cuts. And so like, I think a lot of companies will have more kind of direct exposure, even tech companies, right? That will like have cheaper costs of capital, that will be able to hire more, that will be able to buy more.
I mean, the ones
like,
that are dependent on loans are usually the ones that are the most, have the most, rate sensitivity, and that's autos and solar. Everyone finances solar, right? Unless you're doing commercial installments.
By the way, we had $7 in earnings in 27. There you go. 20 times 7 is $140, $750. My stock's at 70 now. So like that's how you're going to get there, is when people start putting that $7+ of earnings power. And by the way, they do have a ton of, I think that you're not seeing the leverage yet, but they're underneath here. They're shedding fabs, and again, the utilization is at 65.
I think,
so, there's a ton of gross margin leverage, tons.
I think to both of your points, like I think that this is a case where the company is, fairly valued. It's just, and it's probably like a good company in a really bad neighborhood, I guess. So it's like the question is are you willing to pay like a great price, I would say, for like an okay company in my mind, or should you be paying like a fair price for a great company? Like that's
you're paying 17 times, like that's nothing in this day and age. So
that's what I'm saying. You're paying a fair price for an okay company. Yeah. Like, what I mean? You're paying a good price. You're paying a good price for an okay company.
You're a market leader in things that are technically, I mean, they're cyclically depressed. Like EV is crossing the chasm, but like there's no doubt about secular positive trend in EVs, and they are going to be overshared in that transition. And so to me, that's like not a shitty neighborhood. That's not a, it's just a
The
it's a
cycle
very
could last
volatile
until like 2027 or 2028, though. How do you know when that cycle flips? I
don't know.
like the thing, like generally, like I personally like have a hard time making two bets at the same time. Like, and this applies not only to like, I would say companies like this where like they're betting on a cyclical end market, but also like oil companies and like gold companies. And like you're basically betting on both the operational excellence of the company itself, but also on the end market. You're making two bets at the same time. And I think that like increases your risk profile by 2x. And so like I would prefer to bet on a company that's in a market that's just going to continue to expand, right? Like the advertising Google type markets or Meta or Facebook type markets. Like those markets are going to continue to expand. They're pretty healthy. They're super robust. It's not a question of like if they're going to fall and then come back up. It's just a question of like how much they grow, right? It's like,
You
so
think electricity demand is going to grow? This is a play on electricity demand, basically, in efficiency. So I feel like, yeah, I mean, I'll take it.
It's a play on EV growth. It's a play on EV growth.
There's secular threats to it, right? Like AI showing up and making nobody click on anything. So like, I feel like you just gave a really shitty example.
I
Like
think
electricity.
there's tons of risk. Like there's risk on the EV side, right? Just the cycle of EV cars, but also like a lot of what they're selling into is like wind farms and solar farms, and like those things could get replaced by natural gas. Those things could get replaced by nuclear. Those things could get replaced by like dirty energy sources. Like you don't like it's just there's so much cyclicality in these end markets that like you're betting on like 10 different things at the same time.
But all of that turns into electricity that ultimately has to go through an inverter from these guys. Like even if it's nuclear, right? That energy goes somewhere and becomes electricity. It's not like power plants are driving it. So I'm going to argue that these guys
applications that you have, they're going to benefit with the silicon carbide. That's a big. That's a leg up in technology they have versus a lot of traditional power systems.
I mean, they have like some of these things they've won where it's like getting, designing out like raw earths so that, like it's definitely, I think like the sockets are super sticky in their business. They're stickier than they've ever been. And it's really, there's definitely some sticky sockets.
The other thing about, I would say, like electricity build out is that it takes time. It takes years and years, if not decades, to build a lot of this.
This is why you need more efficiency. You need ever more efficiency because you can't make enough. Like everything you do makes them need more semis content.
Yeah, you need more semis in 2028. That's what I mean. You could have an EV like upcycle in 2028. And like we're 3 years away from that. So like expect 3 years of turbulence and then we'll come out of this break. Like it's just that's the thing. Like how do you handicap time?
They agree. It's the question is where's the L? Where's the up on the L? It's guessing like a reflected L, right? It's not a very good L. It's a dyslexic L. All right, well, I guess we'll agree disagree. So 2 on 1, just like at Gordon's mom's trailer. That's a slow night. That's probably like Tuesday at lunch. I think it's Gordon's mom's.
Did you say Gordon or did you say George?
Oh shit! I insulted myself. I don't know how I can use AI to fix that. Sorry, Mom.
All right. So with that,
I can't use that.
Bulls win, Bears win.
Pigs, they get slaughtered.
Awesome.
Pigs get slaughtered. Sweet. All right.